All right, let's get right to our top calls. The big movers on the back of analyst recommendations. And we start off with Macy's, upgraded to overweight over at JP Morgan. Clear confidence in the company's forecast. That was the takeaway from the analyst after he met with executives. He also cites Macy's clean balance sheet and an embrace of private label brand. Shares of Macy's up almost 6%. Next up, let's take a look at Intel, upgraded to market perform over at Bernstein. $30, that's the price target. Hopes there that things are turning around for the chip maker, with the analyst saying the medium-term setup finally improving, and longer-term, quote, Intel's roadmap is not getting worse. Shares up 0.6% on the day. And finally, let's take a look at Wolfspeed, getting cut to neutral over at Citi. Now, this is part of a broader call on the semi sector right now, the semi-equipment sector, I should say, with the analyst saying that while he remains positive on growth in the silicon carbide market that Wolfspeed specializes in, it does fear that the company may lose pricing power as big makers of EVs seek to bring down costs. Those shares down 5.5%, and those are some of our top calls. We do want to pivot from that over to Disney. It just had its annual general meeting, just wrapped up. Jason Bazinet joining us right now, global head of media entertainment over at Citi. Bazinet currently has a buy rating on the shares. And Jason, I want to start here really with the return of Iger. It's been about 5 months here. We haven't seen a huge strategy shift. I am curious as to where you think he could potentially pivot the company. Is the focus going to be as diversified as it used to be, or is it going to narrow to some degree?
Well, it's interesting. I think this is one of the problems for the stock is the street doesn't really know what Mr. Iger plans on doing with the streaming business. That is Disney going to buy the 30% of Hulu they don't own, or are they going to sell the 2/3 of Hulu they do own? And until we have an answer to that question, it's a little hard to figure out what their strategy is going to be in the streaming business. That is, are they going to be sort of niche-y with just Disney Plus, or are they really going to try and go after Netflix in a more holistic way? And Hulu is sort of the answer that we need to get before we know where Mr. Iger is going to go with the streaming business.
Well, Jason, just from the perspective of what it would mean for shares, what would be the best answer that Wall Street could get?
Yeah, it depends if you're talking in the near term or the long term. So if you're talking in the near term, the best answer would be they sell Hulu for an attractive price, and they use the money to buy back shares. That would be the sort of near-term pop in the stock. I actually don't want to see that happen because I think they're giving up a long-term opportunity to really be a leader in streaming video. And so what I'm hoping for is they buy the 1/3 of Hulu they don't own and really go for it. But I'm not confident that that's going to happen based on some of Mr. Iger's recent comments about everything being on the table as it relates to Hulu.
What about the sports franchise? I mean, obviously investors were clamoring a while back for some separation of ESPN and that franchise. I think Iger made it clear when he came back that he didn't necessarily think that was going to be a good idea.
I think you've touched on at least one of the most intriguing things that's going on at Disney right now, and that is they've announced that ESPN is going to have its own reporting segment beginning in the October, November, December quarter of this year. The reason that's so intriguing is in the 4 decades that ESPN has been around, I can't think of a time when the health of ESPN is in greater question, right? So why would you want to open up the kimono and sort of tell exactly what the revenues are going to be and exactly the margins right at a time when sports rights costs are going up faster than ever and cord cutting is happening faster than ever? And I think what it hints at is a strategy for their sports franchise that could put it on a fundamentally different trajectory than the rest of linear television. But that's very much a to be determined.
But do you think that trajectory, and this is just pure speculation that we've seen in the markets, that could involve them actually going headfirst into sports, meaning as sports ownership and owning, having more of a stake in the leagues themselves?
No. I don't think it's sports ownership at all. Our best guess is what the marketplace really needs and wants, at least as consumers, is an easier way to find all the sports that are out there. Mm-hmm. If we keep going down the path we're going down now, all of these individual sports rights that are held by media companies are all going to end up on a different app. And that's just going to be super confusing for the sports fan who's going to be toggling across, 8 different apps. What we think the right answer is that what Disney should try and pioneer is a linear sports package. Something that only has 15 channels, but it's every piece of linear sports content that you could want, at a much lower price. That would attract a lot of sports fans that have already cut the cord back into the fold, and it would give all of these sports channels a much higher ceiling where they could raise price over the next 10 plus years if you sort of get the retail price down to something that's more palatable by kicking off a lot of the non-sports content that sits on these very fat linear bundles with 200 some odd channels.